Hey, welcome to our mini webinar on the remaining pieces of Schedule A. My name is Steve Boisvert and I'm a CPA with Gelman, Rosenberg Freedman. We focused so far on the main portion of Schedule A and the itemized deductions. Most taxpayers are used to getting things like mortgage interest and state and local tax deductions, maybe medical deductions, real estate taxes, that kind of thing. This section is really just a catch-all. Anything that wasn't covered in the 4 previous webinars will be covered here. And that means that we'll be discussing things like casualty losses, miscellaneous deductions, and the repeal of the 3% AGI phase out. And 2 of these potentially will have an adverse effect on taxpayers, and 1 will have a beneficial effect. This is just a cutout of the Schedule A as it used to exist. It's a 2017 version. This entire section called job expenses and certain miscellaneous deductions is gone. Also, line 29 has been repealed, so that's gone. And line 20 has been tightened up as to which casualty losses are deductible, and those are federally declared disaster areas. Moving on here, these are some of the types of expenses you use to be able to deduct, and providing the statute isn't extended, you will be able to deduct in tax years after 2025. You were at one time able to deduct things like tax prep fees, investment advisory fees, unreimbursed employee business expenses, safe deposit box fees, investment journals. All of these were different kinds of 2% AGI deductions. This isn't an exhaustive list, but there may be additional fees not listed here that were at one time deductible as itemized deductions, which are no longer. The main fees I want to call your attention to today are the investment advisory fees and the unreimbursed business expenses, employee business expenses. These 2% deductions were typically the deductions that you would get that would get you over the 2% AGI threshold to be able to deduct miscellaneous itemized deductions. So if we bring back our old Schedule A, the 2% threshold could restrict a lot of deductions. Typically these 2 deductions, investment advisory fees and unreimbursed employee business expenses, would get you over that threshold to be able to unlock lesser deductions like tax prep fees or safe deposit boxes. Line 21 here talks about the unreimbursed employee expenses, and you use Form 2106 to record your work-related meals, job travel, union dues, job education, parking, mileage, supplies, those types of expenses related to work as an employee, not an independent contractor. Independent contractors or self-employed individuals use Schedule C, and none of that has been repealed. There are some changes to Schedule C which we can get into in later webinars. What we're talking about here is you receive a W-2. You're a statutory employee. So anything that work did not reimburse that were job-related expenses could have been deducted on Form 2106, and then that amount would be here. A lot of salesmen and women who use their cars to travel and don't really get reimbursed for the full amount of the mileage they put on their cars will probably see a hit here. Form 2106, which itemizes the expenses, will still be used if you are an Armed Forces reservist, a qualified performing artist, a fee basis state or local government official, or an employee with impairment related work expenses. These are the only groups that will see a benefit from these types of expenses and use 2106. So again, I just want to stress that these are expenses incurred by salaried W-2 employees. If you are an independent contractor or self-employed, you will still deduct expenses related to work on Schedule C. I'll just write that here, Schedule C. These expenses, this section is for salaried employees. So investment fees are just another expense that we see a lot in tax prep. Investment fees are no longer an itemized deduction under the Tax Cuts and Jobs Act, and they would have been put right here, say $3,000. Let's imagine that the taxpayer made $100,000 last year. 2% of $100,000 would be $2,000. So if we just do the math quickly here, we've got a $6,000 deduction, because you take these two lines, total 8,000 minus 2,000 equals 6,000. This is our new draft 2018 Schedule A, and you can see it's just totally missing this job expenses and unreimbursed employee business expenses section. So it's shrunk quite a bit. So we've discussed the 2% AGI deductions that are repealed. That's this section right here. A little bit of good news, though, is that the 3% itemized deduction AGI limitation has been repealed. This was known as the P's limitation. Under the old rules, if your adjusted gross income exceeded, as you can see here, $313,000 married filing joint, $261 single, $156 married filing separate, or head of household $287. If you were in excess of those amounts, your itemized deductions are going to be limited. I'm not going to get into the calculation, but if your itemized deductions were reduced by this limitation in the past, they are no longer, which at the end of the day means you're not losing the deduction benefit and you'll save some money. All right, lastly, personal non-business casualty losses are now limited to the federally declared disaster areas. So for losses occurring in federally declared disaster areas, you must reduce the casualty by $500. For federally declared disasters, you don't have to worry about the 10% AGI limitation though, so that's a good thing. Okay, quick example. You purchased your home for $400,000. This is your unadjusted basis. Remember that term, unadjusted basis. Before the hurricane hit, your property was worth $500,000. After the hurricane, your property was worth $200,000. Insurance and FEMA came in and covered $100,000. So your casualty loss before any kind of reduction is $300,000. That's your hit. That's how much you lost in that hurricane. Then you must subtract from that loss $100,000 for your FEMA and insurance reimbursement, and that gets you down to $200,000. This has to be a federally declared disaster area. Once you take your $200,000 over here, you reduce it by $500, and for your federally declared disaster area, there is no 10% AGI limitation. So you basically, if this guy's AGI was $500,000, and a 10% AGI limitation would be $50,000, because there's no AGI limitation on this number anymore, you've saved $50,000, whatever the tax is on $50,000. So that's a really good thing. Now, this is a really simplified example, but the loss will be limited to the lesser of the unadjusted basis of the property or the loss of the value from the casualty loss. So remember I mentioned this is your cost basis. This is what you purchased your house for up here, this $400,000. What's less, $400,000 or $300,000? Well, $300,000 is less. So in this case, the loss of $300,000 is what you're going to go with. If your cost basis in the property was $200,000 and your fair market value was $500,000, you had a loss of $300,000, then you would have this $200,000 would be limited. Your loss would be limited to the $200,000. So that's maybe a little confusing. If you want more, information on that, don't hesitate to reach out to me. The rules for casualty losses related to trade or business are also a little different. So if you'd like to discuss that, please reach out and we can help you with that. Remember, with casualty losses, the burden of proof falls on the taxpayer. So you have to be able to support the claim that the reason the loss was incurred was in fact because of the storm, the fire, the earthquake, whatever. You need to be able to show the decline in fair market value. Now, what do we do with this $199,500? Well, you would think it would go on line 15, right? Casualty losses and theft losses. No, it goes right here on line 16. You may say, why is that? Well, this is a little confusing. Let's see if you can follow it. The deduction for the federally declared disaster goes on line 16 of your Schedule A, not line 15. Line 15 is the exception to the federally declared disaster clause. So, an exception to the rule that disallows a deduction for personal casualty and theft losses other than those attributable to a federally declared disaster applies if you have personal casualty gains. And those would be reported on line 13 of your Form 4684. That's where you've been declaring. That was the last page we just looked at. You will deduct the portion of your personal casualty losses not attributable to a federally declared disaster to the extent loss doesn't exceed your personal casualty gains. So if you have personal casualty gains, you're allowed to deduct personal casualty losses that maybe aren't affected by a federally declared disaster area up to and not exceeding your personal casualty gains. Then any remaining personal casualty gains will be reduced by the amount of your deductible federal disaster losses. It's kind of a lot to digest. If you have questions on it, feel free to reach out to me. Again, this is not an exhaustive study on the Tax Cuts and Jobs Act changes, but I do hope that it provides some additional clarity and hopefully starts the conversation on these topics. Any questions that you have, would like to discuss, please don't hesitate to reach out to me. As always, you can reach me at my email, or you can call the firm and dial my extension. I'd love to talk to you. Thanks.